Good afternoon, everybody, and a very warm welcome to Knight Frank's webinar that I decided to put together in light of some fairly seismic events that have happened within the last week, but also over the course of the last year. And we're going to be giving you our views on where the residential and UK markets are and how they've been responding to recent events. So I'm delighted that you can join us. I hope you find it useful. There's a question box where you can ask us some live questions, or there'll be our details after that you can come to us direct. So my name is Tim Hyatt. I look after the residential business here within the UK and around the group. But on my left, I have Tom Bill. Tom, do you want to tell the audience a little bit about yourself?
Thanks, Tim. I job title, Head of UK Resi Research. So I look at what's happening across UK residential markets and try and guess what's happening next.
Fantastic. Thank you.
I'm Chancellor Whelan. I'm the regional partner for London sales in the North City and East, so I look after our network of 5 offices in that location.
Ben Sheriff, Head of London for Knight Frank Finance, so essentially looking after the mortgage proposition for Knight Frank clients across the London residential business.
Okay. A really good eclectic mix of voices and opinions. So let's get going. Tom, the gap between the budget and the election, the longest on record or just an unusually long break?
An unusually and unfortunately long period of time, I think. I'm not sure the Labour government would have a repeat performance. It was probably good on the one hand. There's a risk with going too early, whereby you come out with lots of ill thought through measures in an emergency budget. They didn't do that, so big tick. However, there was a risk, I think, with going too late, and you created a sense of uncertainty. We saw consumer confidence survey, a succession of key consumer confidence surveys pointing downwards, and everybody was on edge, really, for most of that time. And that was reflected in the property market. We saw a bit of hesitation. If you didn't really need to move, I think people were thinking about sitting on their hands. So I'm not sure, all in all, waiting 4 months was probably a good idea.
And before we go into the details, how did you really feel about the budget, the budget going into it, and then straight after?
It was a headline, I suppose. The key takeaway was you had a budget where a real change of emphasis, I think, from the last 14 years. So you've now got a government that is more aggressively targeting the private sector to fund what it wants to do in the public sector. And we're all sitting now wondering, markets are now wondering, is that going to work? Are they going to be able to raise the money that they want to raise without coming back to ask for more? And if they did need to come back and ask for more, you can expect borrowing costs and mortgage costs to go up again. So there's a lot at stake.
Yeah. So my view on this is the general election, irrespective of how people might have felt about the result, it was a strong result, which is always a good thing. I think you're absolutely right about the sentiment of the actual budget itself. Very much, it felt more sort of public sector than private sector. What impact do you think that's going to have? Do you think now that we've got settlement and we're going to come into the new norm?
I think there will be a new norm, but I'm not sure that we know where we're going to land yet. So we know that we're in a new rate environment. So that's changed over the last fortnight. We're not where we were a fortnight ago. There's been a leg up in rates. We've got a government that's borrowing more, that's spending more. Financial markets have responded to that. We now have, yields on government bonds have risen. Mortgage rates are starting to rise on the back of that. And so we know that things are going to be, we know that rates are going to be higher, but I'm not sure we entirely know where we're going to land yet. And I think what's happened with the election of Donald Trump in the States, that's probably added a layer of confusion as well. So obviously what happens in the States, can get translated across to the UK. Borrowing costs have risen in the States on the back of Trump winning. It hasn't necessarily translated across to the UK yet, but over time, depending on what he does, and there's this great deal of uncertainty around what he's going to do compared to what he says he's going to do, there's going to be some, rate fluctuations, I think it's fair to say, over the next 12 months. So we know that it's a little bit worse, but it could progressively get worse and worse over the next 12 months. Not I don't think hugely. There wasn't a Liz Truss moment, but I think we could see a bit of a slow motion realignment of where rates are going to be.
It would have been slightly awkward for the Chancellor if the Bank of England had not moved for their base rate reduction last week.
It would have been. It would have sent a pretty negative signal. They didn't have any faith whatsoever that the budget was going to do what they said it was going to do.
Yeah.
I think it was. There's a sort of temptation to overanalyze and explain. Oh, they did this because of the budget, or the Fed did this because of Trump. Those cuts were long expected. They were going to happen anyway. Markets didn't particularly move at all in response to that. But yes, if they hadn't cut, it would have been a big kind of red cross in the column against the budget.
So in America, they've gone up, funny enough, off the back of that particular result. Ben, I'll come to you now. So we've seen 0.25%. Good, as far as I'm concerned. It's an indicator. It's positive, but I think we've been slightly cynical about where the markets are. In the last month, through Knight Frank Finance, you've seen the amount of mortgages organised and, in fact, across the country go up, haven't you?
Yeah, I mean, October was very busy for us, actually, the busiest month in 2 years. The reasons for that, I think partly people were preempting perhaps what was going to come out in the budget.
Yeah.
Swap rates had been going down. Actually, in the run-up to the budget and in the aftermath of the budget, we actually saw, as Tom alluded to, that slight bump up in swap rates. Swap rates are really what the fixed rate market is priced on. For the majority of UK borrowers, that's actually what they're most interested in. What the market looks like post-budget, I think it's slightly too early to tell. If you look at the base rate cuts, there were over 1.3 million borrowers that are variable rate borrowers that will be enjoying that benefit straight away. But as we've said, the swap rate market is disconnected from what the base rate's doing. So really for borrowers at the moment, they're probably more interested in what banks are announcing with regards to rate rises on fixed rates and potentially what's happening with things like inflation, because we know that really plays such a key part in what their mortgage costs are going to be doing over the next couple of years.
Yeah. I was going to ask an interesting question, actually, Ben. If somebody's looking at the moment to fix for 2 years or for 5 years, what kind of calculations do you think they might be making about what the best thing to do is?
So yeah, the differential between a 2 and 5 year fixed at the moment is quite small. So if you're fixing for 2 years at the moment, you can still do it at around 4%. You're probably paying an extra 20 or 30 basis points to fix for 5 years.
Yeah.
I have to say our clients at the moment are opting for 2 years in the majority. There is still that relative optimism that rates are going to continue to come down. The Bank of England is still saying rates are on a downward trajectory, but it's not going to be as quick as we like.
I only ask because I'm one of your clients at the moment, trying to decide.
I knew there's an angle.
If I fix for 2 years, I believe that the Labour Party, the budget's going to work. Rates are going to calm down. But I've put a 5 year option on the table and locked in, just in case it starts looking a bit shaky and the government has to come back and start borrowing more, and then rates rise again. There could be a bit of turbulence. I'm not sure what I'm going to go for yet, but I just wondered if people are increasingly looking at that optionality.
So I think it's early days for us in terms of, I don't think that the budget announcement has really washed through into sentiment yet. I think people are still processing what that means and then how it affects them. And really the mortgage cost is probably the biggest impact that it's going to have and kind of what it does to the economy on a wider scale. It does seem like, you could have some more caution coming in and looking at 5 year products, but there is still that fear that fixing in for 5 years, such a long time horizon, that's 5 years of mortgage payments at over 4%. People don't want to be left holding that kind of cost if rates do continue to go down and the Bank of England does achieve its inflation targets and keep rates under control.
Yeah. It's always that bold step, isn't it? Fixing for 2 or fixing for 5. If we go back 5 years, and I don't know what the rates were there, but they were ridiculous.
Pretty good. So
0.5%, 1%, really whatever it might be.
Really good.
We should have all fixed for 5 years, but we didn't.
Or 10.
I did fix for 5 years
Of
at
course
1.8.
So that's the great
Knight Frank.
statement.
I've got 1.44. That'll be painful when it comes up.
But Tom, getting away from the budget and also the election, just remind everybody the impact on what's likely to happen with the Bank of England, what they do on the current position with inflation and also on unemployment, because they're swinging about, but they're on the up. Things are getting slightly better, which has a positive impact, or.
Well, they were potentially. I mean, the budget sort of, again, changed things slightly. the OBR forecasts, how much faith you put in them is a separate question, but the OBR forecasts are now for more inflation, bond yields that are above where they expect them to be. So it's sort of, the market's still not quite settled down, I don't think, after the budget. The danger hasn't really fully passed yet. And there are still, inflationary risks around what the government's going to do. If it starts, for example, we've seen in recent days what the supermarkets are planning to do with higher employer national insurance costs, that'll get passed on in higher costs, so that'll drive inflation. So there are inflationary risks in the system still. So as I say, we didn't have this Liz Truss moment, but we could have, the picture could just shift in a slightly negative way over the next year or so.
I'm going to come back to you about the markets and predictions and forecasts, etc., slightly later on.
Sure.
Chelsea. The real world, life on the street.
Yeah.
In the world of estate agency. I hate using that word estate agency. We have over 20 offices across central London. How's it been? How's it been so far this year? And how is it now post the budget? What do you think people are going to do? How are people reacting? Is it a local domestic market or is it still international? What's going on?
I think it's a combination of both. I think going back to what we said at the start, we did have this almost 4-month hiatus on decision making and clarity, and that massively impacted us. I think particularly in the less so in the needs driven markets, more so in the discretionary markets of kind of prime central London and the upper price points. I'm an eternal optimist because I'm an estate agent, of course, so I'll take a slightly different view on it. I think speaking to colleagues across the company over the past couple of days, actually what we have now is certainty in every respect. We know what's happening with interest rates, we know what's happening in the US election, we've got a Labour government budget announced, we're really clear on where we stand, and actually there's so much pent-up demand, I believe, that's kind of been in a holding pattern for best part of a year that can now make a decision. They may not like the outcome, it may not be perfect, but they can make a decision. So I think that's a really positive thing. In terms of the London market and what we've seen over the past couple of weeks, it's been fascinating. A midweek budget meant a huge Monday to Wednesday for the London residential business in terms of the volume of sales that we transacted on.
It's ridiculous. Deals being done up until 1 minute before midnight.
1 minute before midnight, yeah. We had deals being announced. I don't think lawyers managed to get home for dinner that evening, and that was obviously completely unexpected. It was a curveball, the stamp duty amendment that was announced. So, I think we transacted on £160 million worth of property in that 3-day period. I think anything that happened before Wednesday was a bit of a sort of hedge on what might happen. I had a client in London Bridge. We sold their townhouse at £5 million. That was a second property for them. They were very concerned about potential rises to capital gains. That didn't happen, albeit we engineered a very quick exchange and completion before the budget to sort of stop that. So I think Monday to Tuesday was a real hedge against what might happen, and Wednesday was a race against the clock for anyone trying to transact.
And to make it specific to the patch you look after, the offices are in what region of London?
They're across the North City and East, so it's kind of anything ranging from St John's Wood and your super prime markets there, over to Islington, very needs-driven, and then Canary Wharf, which is the sort of slightly more of that kind of buy-to-let landlord market. So it's quite a varied range of markets.
Yeah. And I don't know whether you agree, but personally running the business, I found I've been trying to think of the best adjective to describe this year, and turgid springs to mind. It's been really stop-start. For us on the agency side, we come out on mortgages, on all parts of our business. We come out from the Christmas break and there's always that sense of optimism. And I think that was beginning to gain momentum.
Yeah.
And then hang on a second, let's have a general election.
Yeah.
So everything begins to slow down. We had the general election slightly later than we thought it was going to be. That was done. And then this sort of evolution of this sort of summer break that now seems to happen when everyone takes a month off instead of the old days when it was a week or 2 weeks. So we had that. Then there was the announcement about the budget. Then it was 54. How long was it between budget and election? 54.
117.
Over 100 days, wasn't
100 days. That's a long time, which we discussed earlier on. Then we had the American election. And now, thank goodness, we're in a position where I think, as I said, it's going to take 2 or 3 weeks, but we're going to start to really feel the new norm. Would you agree that's how it's been for you?
Yeah, completely. We went into the year thinking probably likely an autumn election. So let's do what we can for the first half of the year. That completely changed. We had it in summer. So yeah, it's been very stop-start, and that's why I feel good about where we are now, because we know where we are, and we can all then make decisions moving forward. And I think just from a sentiment point of view, whilst the interest rate drop, it's not having any kind of immediate impact on rates. I think it's just very positive news out there for the likes of first-time buyers and those coming into the market. So I think we welcome that.
I think there is definitely still a feel-good factor to base rate
Yeah,
coming down.
definitely.
Obviously, it's a sign that things are under control, and I think it's easy, although we're not going to see this huge benefit with actual mortgage rates, its headlines do impact sentiment, and that people have been waiting for.
Sure.
Yeah, totally.
I think we just need to wait. That's all the good news. We know where we stand. We know the new rates, but we'll just have to, rather boringly, we'll wait and watch what happens in money markets and see how they react to Trump and how he comes in and what he plans to do.
Yeah.
What was I going to say? I think for first-time buyers, actually, you mentioned those, Chelsea. I think that we could see more of them accelerate their plans, actually, because from next April, they're facing up to another £6,000.
The stamp duty holiday ends,
You could see a bit of momentum coming next spring from people looking to beat the deadline. Actually, what we saw during the pandemic, even in sort of prime markets, people resent paying £1,000, £2,000 to the tax man, and they were trying to get things done before the end of March. So I think across the board we'll see a bit of activity next.
So you might have another little election budget
burst.
spike burst.
Yeah, I think that's true. I think we will see a bit of that, and I think the budget was a shame to not see that extended. I think actually for first-time buyers, because where you've got that surcharge coming in for second homeowners, I think you're going to see more pressure coming in terms of rental prices in London. They'll continue to go up. You've got first-time buyers in London trying to save, and then they're going to lose this tax saving that was introduced. So
a lot of those
bit of a shame.
Go across to the rental market and increase demand in the rental market at a time where it's that sort of
vicious cycle.
I'm going to come back to that in terms of the investment piece and financing on that front. Let's go into the specifics of the budget. We make no secret, Knight Frank is a brand, especially on the residential side, where we track global wealth. We've become a proper global platform now. We're represented in 52 different territories around the world, 26,000 people supporting our clients' needs. But there's been this build-up about the non-dom piece, and whether we're going to see 98% of non-doms exiting London or 10%. There have been all sorts of different stats going around. Let's just have some clarity about what the non-dom piece means, if there is any clarity, what you think it's going to look like, and what's been the real impact, if we've felt it yet, about international buyers in London.
Sadly, there's not a lot of clarity about what they're going to do next. I think the Labour Party stuck quite closely to its manifesto commitments. It's quite a harsh regime that they're proposing compared to other countries. They've also abolished business property relief, which I think was a real shock for some non-doms. That relief on inheritance tax. So for those entrepreneurs, I think a lot of them will be thinking twice about what they do next. There was a couple of positives. There was a longer period of time where you could bring your money into the country at a lower tax rate, the so-called transition period onto the new regime. There was some sort of obscure IHT rules that were slightly better than expected. But overall, I think it wasn't particularly good news. It didn't go down well. But the government is still talking to the lobby group. So you have a lobby group called Foreign Investors for Britain who have really pushed this agenda and talked to the government about what it means. And their argument really, and I think it's resonated in the government. Their argument is that non-doms, it hasn't been a loophole. They've just been obeying the law, paying the taxes as they've been able to, and they're happy to actually pay more tax to stay in the country. And if there was to be some kind of flat tax regime or tiered tax regime, as there is in Italy, then I think you would find a lot of people looking again, staying in the UK. And the government is still talking to them about some sort of flat tax regime. It didn't come in with the budget, but that conversation is still going on in the background. That's why I say there wasn't a lot of clarity at the moment. So up front, it looks like pretty bad news, but actually there are conversations ongoing that could eventually lead to some sort of some better news.
We also track the favourabilities of cities around the world between here and Paris and New York, etc. London's still got so much to offer as a corporate city. Do you think it's going to lose its favour at all, or if it's lost its touch over the last year? Do you think we've got a bit of rebuilding to do? Because that will have an impact on your buyers, and it'll have an impact on the amount of people taking out debt.
I think that's probably true. It's probably some of the lustre has come off, to be frank. But I don't think, people have been coming to London for hundreds of years for a long list of evergreen reasons. They don't go away with a change of government or one particular budget. Things like education and all the arguments.
Education's a really big one, isn't it?
Huge,
Education's probably doing a lot of the heavy lifting at the moment, but I think people will still want to come to London for all the reasons that that we're familiar with. So I think at the moment there's perhaps a sense of watching and waiting and seeing what they do. For example, around is there some kind of flat tax regime that gets introduced? What other policies might the government start to think about? And I think ultimately, London is still going to be attractive.
Back to the street. What's been the immediate reaction? Have you seen any of your international buyers just saying, Chelsea, we're out? We don't like what's going on here, we're going to go? Or are they holding their nerve and just saying, no, London is London, we've got a need, we've got children being educated here, or all the reasons that Tom said?
I've seen a little bit. I've got one client moving to Monaco, so there's a bit of that going on.
Okay.
But it's a small portion of, and as you...
To our office in Monaco.
To our office in Monaco, of course. Yeah, James Davis looking after them. So it's a small portion, but on the whole, the non-dom conversation's been going on. It's not recent. This has been evolving over a period of time, and even in the run-up to the budget, we had some superb £10 million plus exchanges taking place months, weeks beforehand, knowing that this was coming down the track. So yes, it's a part of the market, but it's not the be-all and end-all of the prime and super prime markets. There's still plenty of UK-based buyers that are active in that price point, 30-dayers that are here. So yeah, it will, of course, have a bit of an impact. It's having an impact on decision-making, but we're still seeing some good results coming through.
Yeah, I mean, I think we've been looking at the stats, haven't we, for super prime deals. What's happened, and this is the information that we've been getting from our private offices, we're a handful of deals short of where we were this time last year.
Yeah.
What's happened is that the mega deals, 20, 30, 40, 50 million and above, that slowed right down. And we got into a sort of new super prime sweet spot, I think, hovering between 10 to 15. It's not to say there are not some big ones being done, just not so many.
Yeah, and I think it may change what people decide to do. They may decide to go into the super prime rental market for a period of time before they make a decision. So that market, I know, is performing really well. So yeah, I think it's that. It's we're seeing the same in the prime going into the core markets as well. We're just seeing people maybe not going so all in on London property than they maybe would have done previously.
And do you know what? I'm okay with that. I think our super prime lettings team have got 3 deals under offer at 25 grand a week.
Yeah.
Plus, which is extraordinary. But that just goes to show the wealthy are still in London.
Yeah.
They're just wanting to rent so they can get out quickly if anything worse happens.
Absolutely.
And also, a lot of them like the idea of renting before they buy, right?
Completely. So and they're going to pay it in tax anyway, so they might as well try before they buy. They might as well see how it is and see how it pans out over the next year or so before spending the money on tax, which has, of course, gone up because most of them are second homeowners anyway. So, yeah.
And Ben, the impact on international people taking out debt, has that changed at all?
Yeah, I mean, look, very similarly to what we've been seeing across the residential offices, the market's been really driven by domestic buyers. So we've had less activity from our international clients. That being said, there's still a huge number of international clients that own properties and have mortgages here. If you look at the prime and super prime space for debt, it's largely discretionary, and actually after the mini budget, as rates spiked, a lot of that debt was paid off. So those that could, when you were faced with a rate of 6% plus, it became a lot less appealing, and actually that kind of opportunity cost of what you're doing with your money or the need for liquidity, that question really was, much harder to justify. That trend is starting to reverse now, so you are seeing people looking at debt as a viable solution. If you're paying interest rates that start with a 4, then it still makes sense to keep that liquidity. There's obviously still tax advantages to having debt on your UK assets. If you're not UK domiciled, it definitely helps with things like inheritance tax. So those reasons are all still there. As I say, the domestic market is still the big driver, but there are examples that we've seen of international clients looking at high loan to value leverage on trophy assets. So, in the last 12 months, we've done 85, 90% deals on 30 to 40 million pound properties. Again, paying quite considerable repayments because the interest rates are higher than we've enjoyed for the last 10 to 15 years.
Yeah.
But the purpose of it really is that kind of tax mitigation strategy that still makes sense. And I think we'll see more of that, hopefully, with a few more base rate cuts. They do come to pass in 2025 and onwards. That logic will continue to be there.
I'm going to put you on the spot, and you might not know the answer. It might be something we've got to come back to you. But if we look at some of the hotspots in terms of the non-DOMs, we've heard a lot about Italy and what's going on there as a favourable place to end up, Monaco or Dubai or New York. How do rates around the world compare to London and what we're having to pay? Look at that.
Probably maybe one that I can answer a little bit more. I mean, if you look at Europe as an example, rates have been coming down there relatively steadily. I think you've got Euribor down at 3 now. So it started cutting earlier than the Bank of England. It's a little bit ahead of the game. They've been, I think, more consistent. You're probably, you're still going to be paying 3.5% to 4%. But typically with those kind of deals in those kind of locations, it's private bank debt. You've got assets that you need to give the lenders. There's very little dry lending there because the pool of lenders is much smaller. Dubai market's very hot. I couldn't tell you what the interest rates are today, but I don't imagine they're going to be cheaper. I don't really think that's being factored into the decision for that client base, really.
Yeah.
It's more about their overall wealth picture and how that's being impacted by the changes to non-dom rules, things like capital gains.
Yeah.
The interest rate is more, I think, slightly more academic for those clients.
So again, it puts us into the norm, really, doesn't it?
I think the other thing to factor in is sterling and how much if you're dollar denominated or dollar pegged, you're benefiting from fantastic discounts still. So I think that is really still big part of the thinking.
Don't forget to send in your questions that we can answer as we go through the course of the next 10 minutes or so. So moving away from super prime, because I think we've covered that, the non-dom piece, that just seems a little bit murky. We're still not really there yet. No mass exodus yet. We don't think it's going to happen. We think we're going to be going to the new norm. What seems to be doing pretty nicely at the moment is the domestic market.
Domestic market's doing really well. Our South West London teams are having a record year. So all of those markets are sort of very needs-driven, upsizes, downsizes, etc.
So that's Richmond, Chiswick, Battersea,
Wandsworth, Dulwich, an incredibly busy market, and Fulham as well, having a really good time. So those markets are doing really well. As are the sort of below sort of £4 million market across London, the sort of smaller flats and houses, they're doing really well. And I think that's that pent-up demand piece. I think people, that's emotional. That's life needs to move on, and we're seeing that in the capital gains sort of question mark and whether people wanted to come into the market or not. This is really just people moving between.
I think you said it. Life goes on.
Life goes on completely.
I do think you mentioned earlier, perhaps with our international buyers, not going all in on the UK, and I think that's something that interest rates have done in the domestic market, is perhaps pared back people's aspirational kind of property targets.
Yeah.
So one less bedroom or slightly smaller property, and they're in the 3 to 5 million space. So, and interest rates are probably having an effect on that. So that kind of servicing cost of that mortgage is playing a part of that decision.
Yeah, I think that makes sense. And I think also with stamp duty as it is, I still think a lot of people are skipping that mid move. I think they're just doing the house. They're just selling a small flat, and then they're going straight to as much as they can get to and move into the house. So there's less of that kind of slower upward movement, which has had an impact on supply coming to market in those markets as well.
So let's just go back to the nitty gritty, the stamp duty piece. So I mean, I know the audience here is going to be aware of it, but what specifically? What are the details?
Details are fairly straightforward. The additional rate of stamp duty for second homeowners has gone from 3% to 5%. So that takes the top rate of stamp duty. The marginal rate of stamp duty is 19% if you're a non-resident, so that's pretty high. I think I do wonder how much further it could be pushed, because obviously when you push tax rates too high, your revenues start to fall. That's the famous Laffer curve.
Tom, on that, how does that compare, that top rate, compared to some of these other countries?
It's you can look at other parts of the world. Look at Asia. There are some very high rates. So it's not as though it's globally a huge outlier. Particularly, it was sort of mid-table. It's probably still the mid-upper table. That's gonna make people, I think, hesitate and think about things. But things, as we know, over the last 10 years, stamp duty just eventually gets factored in.
Yeah, it does.
Gets washed through the system. But a top rate of 19%, it's a lot. But we'll just we'll keep an eye on how that changes, if that has any impact on pricing. And that was really, I suppose, the biggest change. And the other one, as we mentioned before, was the nil rate band is not going to go back to what it was, as the Tories were planning to do. They're going to drop the nil rate band, increase the nil rate band. So that's that extra £2,000 stamp duty, £2,000 on your stamp duty bill, or £6,000 if you're a first-time buyer, approximately.
It's uncomfortable,
Yeah,
but it's still doable, especially if
so.
people are buying against the dollar.
Absolutely. And I think what's probably helped a little bit as well is the fact that capital gains tax hasn't been raised.
Yeah.
So there's an entry cost that it's a one-off entry cost that you will perhaps swallow or will get factored in by the buyer and the seller. But where you've got this unknown, gain at the other end, and the potential for that tax on that gain to rise to sort of 30-40%, that's now gone away. There's a lot more certainty. So they know there's an entry cost of X, but the exit cost is as it was. So I think that's helped mitigate the stamp duty increase.
So something that we've been playing around with recently is the forecast that you put out every year, in comparison to how we feel now.
Yeah.
Post the budget, post the election. I'm not going to put you on the spot now to say, are we changing it or not? You can have a go.
We will be looking at them again, definitely.
But if we compare it, where the market stands in its cycle in terms of value, what can you say about that?
Well, I think so what have we got? We've got 3%, I think, for the UK in 2024. It feels like the market is on track to be pretty much 3%. If you look at the sort of the Nationwide or the Halifax, I think we've got Prime Central London flat pretty much, which I think again feels vaguely on track. We'll look at our forecasts again.
Yeah.
I think there are bigger risks now around particularly prime markets, but it feels like we've had the pandemic. We had a huge price increase since the pandemic. That slowed down, but you've had a bit of a roller coaster, I suppose, over the last 2 years with the mini budget, with persistently high inflation. It was all starting to calm down nicely, as you said, and then along came the election and the budget. So there's a lot of digesting still that's going on, but the path has felt as though it was sort of moving upwards as rates started to come down. And now, I suppose, we'll just see potentially a sort of shallower path upwards for house prices. The other important thing, actually, probably to bear in mind when you think about the impact on house prices and demand, and this shocks a lot of people to know this, more people own their own homes outright than with a mortgage in the UK. Yeah. So there's a lot of cash in the system, and I think it makes the housing market actually pretty resilient. If you go back 10, 15 years, it wasn't the case. There was more, there were more leverage buyers. So now I think that there's a lot of cash in the system, a lot of equity, and I think that will also help support demand.
I mean, Ben, you know that, don't you? I mean, out of all the deals that we do, all the inquiries that we get, a lot of people, 40% are cash?
Yeah, there's still a lot of cash around, absolutely.
Especially in certain markets as well overall.
Yeah, and and I suppose the more you go up the market, the more that cash is available. Again, for us, I think we're still always surprised at how many people still look at debt not as a necessity, but as a tool, and whether that's for tax or liquidity. But yeah, absolutely. I think broadly, though, that what Tom's referring to is just the sheer number of people that generationally have ended up owning their own homes and have paid those mortgages off.
Yeah.
So what you're not seeing is that kind of repossessions, the forced sales, that doesn't seem to be a huge
You've
feature.
got many more people on fixed rate mortgages compared to 10, 20
Lots.
years ago as well. So there wasn't a kind of cliff edge moment at any point,
Yeah.
as there might have been 20 years ago when people were all on trackers.
Yeah.
It was a lot smoother.
Yeah.
Yeah.
Plays into the bank of mum and dad as well, slightly. If we,
Yeah, absolutely.
that second home owner thing. It's not always landlord. It's sometimes a motive. It's sometimes parents buying for children, or it's lifestyle led, etc. And we do see a lot of clients taking money out and helping children.
I do
And
think
all the support that I think the government are going to feel compelled to wanting or needing to do in terms of A, the housing crisis, and B, getting people onto the property ladder.
Yeah, there wasn't anything in the budget particularly.
No, it's really
it went the
disappointing.
other way, if anything, for first-time buyers. And I think with when the renters' rights bill, as it goes through Parliament, as it sort of takes shape, again there could be some unintended consequences for that in the form of lower supply and higher rents. So
we're really seeing it, aren't we? Over the past few years, the rental prices have just
rental prices went
Through the
crazy,
Through the roof.
and they're just starting to calm down again.
Yeah.
And now along comes the renters' rights bill, and it could see things.
And what are
back
your
into reverse.
investor landlords or your investor buyers thinking about the market? Are they suddenly saying, this bill coming through, we're out, we don't like the sound of it, or are they just staying? I mean, I think the average buy-to-let landlord is in it for 16 years.
Yeah, well, we saw a lot try to exit this year, well ahead of the budget, well ahead of sort of any thoughts around capital gains.
that was fear about
It was
CCT.
fear, yeah, completely. So we saw a lot try to exit. If I'm honest, we don't see many new investors enter the market. It used to be, and I've been doing this for quite a long time, and you used to have a handful of people who were always looking for investments to rent out. It feels that that's a lot thinner now in terms of new landlords entering
What
the
are we
market.
at yield-wise at the moment?
Prime central London yields, I think they're pretty good, 4%. I mean, it's
Yeah,
Yeah.
not bad.
it's decent, and that's probably as an average. Some places higher, some places lower. So yeah, the rental returns have been good.
I think it's legislation as well as taxation here, and I think there's a lot there to deter new landlords from entering the market, and it is a problem. I think in this country we seem to have a real emphasis, or it's only good if you buy something for first-time buyers or young people. It's sort of seen as a second-rate thing to be in the rental market, and you must aspire to be a buyer. I think we've got that slightly wrong, and I think we need to encourage more build-to-rent housing. We need to help more investors to make that happen, to change planning restrictions so that we can build more, and just, I suppose, change the narrative around what it is to rent in London or rent in the UK, because I don't think it should be seen as a second-rate style of living.
You mentioned build to rent. That for us is absolutely the busiest side of the buy-to-let markets at the moment. Casual buy-to-let investors are very, very thin on the ground. If you're looking at
Yeah.
second home stamp, an additional 5%,
Yeah.
even for accidental landlords, so the ones that own their own homes and aren't selling to buy something else.
Service charges as well, holding costs, service charges
Yeah.
are going up through the roof with rising energy prices, etc. The service charges in most buildings
Absolutely.
are really
Well,
high.
I've got a slightly different view on this than you guys have.
Have you?
I mean, I'm a landlord, and I'm not making a buck out of my thing, but I never want to make a buck out of my rental income.
It's a long-term capital.
I'm going into
play.
a long-term play.
Yeah.
I'm going onto a repayment mortgage, and I'm getting my tenants to pay, 60 or 70% of my pension. They're paying down on the debt. I'm covering my costs. I might have to chuck in a little bit for the service charge,
Yeah.
insurance, whatever it might be, but I'm all right. I'm still very much a long-term landlord.
That
And
makes sense.
I think there are, if you go across all of our instructions, especially within your area, there's some deals out there. So you might push that yield up above 4. You could get to 4.5%. You might even get to 5% if you buy well. Get yourself tied into a repayment loan, and actually it's not bad.
Interest rates for buy-to-let mortgages, they really spiked after the mini budget. It tends to be when we get a kind of shock into the market, buy-to-let rates accelerate because they are perceived as high risk by lenders. That margin has come right back down, so they're very similar to residential rates at the moment. The biggest problem is for kind of the average investor, getting a high loan-to-value buy-to-let mortgage is harder because the hurdle rate of interest coverage over the rental amount is more difficult to achieve. And that's, I think, why we're seeing this build-to-rent surge. Property developers are classically more bullish about the market. They tend to get in slightly earlier. And because they are doing essentially either conversions or ground-up development, there's more margin there for them. So, they build 25 units. Actually, rather than selling them, hang on to them, flip them onto a buy-to-let product, and actually those look like really good investments. I think for the people that own buy-to-let properties and already hold them, there isn't this big cliff edge of fire sale. We don't have a CGT change. So, absolutely going back to your point, Tim, there isn't this sudden urgency to change your position. You probably weren't relying on the income for your kind of day-to-day running costs, so it's not so important, and actually there's still a long-term benefit to that capital growth. But if you're looking at it coming in today, do you want to be spending that kind of entry cost with, I suppose, all of the tax regime around it as well? It's a much bigger decision.
Yeah.
You've got to use a corporate vehicle. Owning in personal name is very challenging now because you're going to be taxed at your top rate of income tax. There are still ways of doing it, but it's got to be a more considered decision than perhaps it was in the past.
Yeah.
Okay. I'm afraid we're running out of time, so I'm going to have to start wrapping up. Tom, shoot from the hip. What did you really think of the budget?
Of the budget. It was a missed opportunity, I would probably, in a nutshell. It's a change of direction, and we'll see whether it's a change of direction that's headed on a good trajectory. Whether it's going to work or not, I think is still the jury is still out. But targeting of the private sector more aggressively, I think, is going to have all sorts of unintended consequences, as I mentioned. So overall, it felt slightly confused, and will probably be in a much better position to judge in 2 or 3 years' time to say, well, actually, did the government raise this, this, and this? And if it didn't, why not?
But speaking to the officers that you have been doing, like we've all been doing, it's not a slam door. We haven't just suddenly down tools and we've seen it. We're now regrouping as an entire residential business, thinking, okay, hang on a minute, we are in a very different world now.
I think if I had to sum it up in an emoji, it would be a face palm.
Yeah.
I think people are sort of slightly...
A face palm.
One of those. I don't think
it would be one of those slightly smiley faces, I think.
Yeah,
just not
slightly
I'll
smile.
go for the smiley face.
Didn't stop the market in its tracks. Just kind of thought, people looked at it and thought, well, okay, let's deal with that. Let's factor that in. We'll see what happens longer term to rates. That's still a question mark, but as we've said throughout, life will go on.
And Chelsea, from your side, you're pan-London.
Yeah.
The domestic market, even post-budget, is actually pretty strong.
Really strong.
I wouldn't say it's on fire, or maybe it is on fire.
Kind of is on fire, depending on where you are. Southwest is definitely on fire, like Islington, for example, doing really well. So, look, I'm a small, slightly smiley face. I think we know where we are now. There hasn't been any mini-budget chaos fallout that we saw when that happened. Teams are doing really well. There's offers being agreed. Pipelines are building nicely. We're agreeing some really good prime and super prime stock because people can make decisions, and that is a really good thing, I think. So.
Great. Ben?
Don't know what emoji I'd give you, but I think the sentiment that we have from clients at the moment is they're just getting on and moving forwards. Decisions are being made. Our phones are ringing, and I think that's very different from over the last few months where people found that very hard to do. I don't think people necessarily know where house prices are going. I think they still feel reasonably confident the Bank of England's got it right with inflation. And that, to us, is definitely the overriding factor that kind of helps our market and keeps things moving along. So as long as that continues and I think that confidence stays there, I think we can look forward to good activity levels over the next 6 to 12 months for sure.
Great. I think debt is now manageable. It's the new normal. I don't think we're saying that property prices are going to drop.
No.
In fact, far from it. I think there's an opportunity to miss it. When you've got momentum like you've got within the domestic market, I think that's going to build. We'll see what happens with the upper end of the market, but we are not seeing the exit that we thought.
And there has to be pent-up demand.
There has to be pent-up demand. So I'm a thumbs up, actually. I'm a thumbs up. I think we'll track the markets for you very closely over the course of the next few weeks. Tom will be, as ever, out there in terms of his commentary and is available should anyone want to speak to him about his views. We have an award-winning mortgage business here that is here to help, and a very strong team of over 300 people on the estate agency side. So from my perspective, I hope you found the session useful. It is live and it's raw, but every question that I've got here, I don't think we've actually asked each other, but that's the best way to be. If you are an international buyer in a certain area, the answer to that is if London is not your chosen place to live now, that's fine. We can use our network throughout Europe and further afield to house and help and advise you. As I said, we are represented in 52 different countries around the world. And all the sweet spots are where people might be going, be it the Middle East, be it Dubai, be it Monaco, Chelsea's the example earlier on, be it Italy. Well, we have networks there and very strong businesses to be able to help you. So thank you for your time. I hope you found it useful, and on to the next one.